Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 49, titled Analyzing and Calculating a Multi-Leg Rolling Down Covered Call Trade. And we're going to use a real-life example with NIKE Corp, which trades on the New York Stock Exchange under the ticker symbol NKE. Now, when we enter a covered call trade, or really any option trade, there are three required skills. What stock are we going to use? What option are we going to use? And how do we manage our positions? We're going to focus in trade management, exit strategies in this podcast. Now, as far as covered call writing is concerned, we have several exit strategy opportunities that may or may not come up during the contract month. They all start the same way, by closing the initial short call, buy to close. Then we can either hit a double, which means buying back the option and reselling the same one if the price of the stock recovers. Rolling down, which is going to be the focus of this podcast, where we buy back the short call and sell another in the same contract at a lower strike price. The mid-contract unwind exit strategy, where the price goes very, very high above the strike, causing the time value of the premium to approach zero. There'll be a large intrinsic value component, but a very small time value component. We can close that and use the cash to enter a new trade, hence the term hitting a double. And the mid-contract unwind exit strategy also allows us to generate two income streams in the same month, much like hitting a double. Converting dead money to cash profits, where the stock is really underperforming despite our rigorous screening, and we decide just to close it up and enter a new trade, cutting our losses. Then rolling out, when the strike price is in the money as expiration approaches, we roll out to the next month's same strike, or rolling out and up, where we roll out to the next month's higher strike. So those are our opportunities. We're going to focus in on rolling down in the same contract period. So let's look at a real-life covered call trade with NIKE from the July 2020 contracts. Now, on June 22nd, 200 shares of NIKE was purchased at $97.72. That same day, June 22nd, to July 17th expiration, so almost a month out, 99 out-of-the-money calls was sold for $1.60. We immediately set buy to close limit orders based on the 20% guideline at 30 cents. The buy to close limit order was changed mid-contract from 20% or 30 cents down to 10%. In this case, it was 15 cents. Now, if we took a look at the initial structuring of the trade, with NIKE trading at 97.72, selling the 99 call for 160 would generate an initial time value return of 1.6% for the month, with a possibility of an additional 1.3% if NIKE moved from 97.72 up to the 99 strike. So there was an opportunity for 2.9% 1 month return. But that's not what happened. NIKE actually started to go down in value. So here are the rolling down exit strategies that I used during the July contracts. The 20% threshold, or 30 cents, was never reached. However, in the latter part of the contract, the 15 cents was realized for the first time on 7/16. So it was almost at the very end of the contract when the call was bought back at 15 cents. Now, on that same day, I rolled down the 99 strike to the 98 strike, and that generated a premium of 48 cents. So we had a credit of 48 and a debit of 15, leaving a net credit of $33 a contract. Hey, why not? $66 for the two contracts. Now, once I entered that sell to open at 48 cents, I immediately put in another buy to close limit order based on the 10% guideline, and I set that at 5 cents, 10% of 48 cents. And that was reached on the same day. So the 98 strike was closed at 5 cents, and I rolled down to the 97 strike, which generated 13 cents. So I had a net credit of $8 a contract on that rolling down trade. So if you looked at the broker statements, you would see that there were net debits on the buy to close limit orders of 15 cents first, then 5 cents, and then net credits on the new sell to open orders at 48 cents and then at 13 cents. Now, if we took a look at this trade as a whole, we could see that we actually turned a losing trade into a profitable trade. Here's how it breaks down. The share price started at 97.72 and ended at 96.28. So that resulted in an unrealized, since we didn't sell the shares, unrealized loss of $288 for the 200 shares. But we received option credits of 160 first, 48 cents second, and 13 cents third. And option debits we incurred at 15 cents and 5 cents for the two 10% buy to close limit orders. So the option side resulted in a net credit on the 200 shares of $402. So when we factor in the credit of 402 and the unrealized loss on the stock side of 288, that resulted in a net profit of $114 for the two contracts. So we turned a losing trade into one that had cash in our pockets. So option selling exit strategies will mitigate losses. Doesn't always turn losses into gains as it did in this case, but it will definitely mitigate losses. In this NIKE example, it showed how using multiple rolling down exit strategies actually put cash into our pockets rather than taking cash out of our pockets. So with exit strategies, we must be prepared to take advantage of these opportunities whenever they arise. Now, for more information, visit our website, www.thebluecollarinvestor.com. Check out our free resources link on the top black bar of our web pages. We also have free video available, as well as a lot of articles and videos that you can get for free on the general website. Now, in our store, we have online DVD programs. We have ebooks, hard and soft cover books, as well as calculators, trade planners, and online mentoring programs. So check out our blue collar store if we're looking to master option selling strategies like covered call writing, as well as selling cash secured puts. Also, on our blog page, check out the newsletter. We have a free newsletter. You could fill in the form there, and it'll be delivered to your email box every Sunday morning, 10 a.m. Eastern Time. So, ladies and gentlemen, thank you so much for taking the time to listen to this BCI podcast, number 49, analyzing and calculating a multi-leg rolling down covered call trade. And we used NIKE as our real-life example to show you how I converted a losing trade into a profitable one. So I hope you enjoyed this podcast. I hope you make some money from it. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.